Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Close Show. As always, Scott Carson, excited to be here with you today. Today, we got a very special guest, and I know he's probably going to answer what a lot of you have been asking me over time. And I know a lot of folks always, when they hear what we do, like, hey, do you have a fund? Or hey, how do you pick a fund? How do you find something that's right for you? Well, I'm excited to have somebody who's been a real estate fund manager for 25 plus years. He's known as Big Mike. He's the head and the head honcho, head podcast host over at the Big Mike Fund podcast. Definitely want to check it out. Lots of valuable nuggets over there. I've been binging it the last couple of days. But this is a guy I've known for a few years. Actually, we were part of a real estate mastermind a few years ago. Got to know each other, talk about the mortgages, talking about stuff. He's a math junkie like me, but he's definitely a mathematician, much better at it than I am. But anyway, so honored to have Mike Zlotnik joining us here on the Note Close Show. What is going on, Mike? How you doing today, bud?
God, thank you so much for having me. I appreciate your kind words. Just it's a journey. Life is a journey. Enjoy the ride, right? It's just kind of everything is a journey. We're progressing through some market volatility in real estate, and we'll see. We'll see what happens. At least we know we've peaked on the interest rates. Things supposed to go down from here. How fast? We'll see. But at least interesting opportunities. Very different than a few years ago.
Yes, sir. Never a dull day. And I love the logo you got there, Tempo Family. Real estate is not a race, it is a marathon, and you got to keep that tempo going in a lot of cases, no matter what kind of curveballs that the economists or the market will throw your way. Definitely. So tell us a little about kind of how you got invested in your background and journey, how you got to where you're at today before we dive in some of the deeper stuff.
Sure. So I've been a passive investor since 2000. Bought properties in New York City passively. I had a career in technology and being a mathematician, sort of computer science by education, and spent 15 years there. 2009, I was done with the technology career, and I went real estate full time. But been passive investor, as I said, 2000 to 2009, and active full time since 2009. Yeah, I live in Brooklyn, New York. My lovely wife, 4 monkeys and a cat, 4 kids. So they're grown up. I actually have a cat, a real cat. So that's
Nice.
it. And just right, we're on Temple Family of Funds. I really come up with a name. There are multiple funds, multiple strategies. We do also syndications. And today we're adjusting to the times. So during equity days, there was equity syndications. Now we're not necessarily doing exactly syndications on debt front, but we're focusing more on debt. And this is much more dear to your heart because the market conditions have changed. It's better to be a lender now than during the days when equity was more interesting. Today, it's a little bit more defensive to participate in the debt investments.
Yeah, I would agree to that. When you see a lot of the stuff that's been coming across our desk and platform in the last 12 to 15 months, we've been doing like a daily short video on any different non-performing commercial property going to the foreclosure auction, what's been selling, or seeing banks trying to sell that debt off in the secondary market so they don't end up with the asset. It makes for an interesting time. You've done a variety of things with your different funds, and when you're looking at stuff and investing in funds or trying to create stuff, what are probably the 3 or 4 biggest questions that investors should be asking when they're evaluating a fund?
Well, I have a book out. I'm working on the book 2.0, right? The
There we
book
go.
is really how to choose a smart real estate investment fund and top 10 questions investors should ask. So I'll run through the list. Literally, I just go through the top 10 questions and then we can talk about that.
You gotta I do my research. Throw you a softball there, buddy. You know what I mean? So we know exactly. A little promotion of the book.
I
I love it.
appreciate that. But we are evolving to the next generation of the book. That was a short book that's still available on Amazon. But let me just run through the list. So,
Sure.
what's the security of the investment? That's the number one question.
Yeah.
So, we could talk quite a bit on that. Of course, if you're on a notes play, you need to understand what are you buying, what's the LTV, who's the borrower, the whole 9 yards. But ultimately, it's the security of the investment.
Yep.
Even when you invest in a fund, you need to understand how the fund invests and what is security. If the fund is a lending fund and has a bunch of deeds of trust in first position, you have a pretty good security, right?
Yep.
If the fund is doing some aggressive equity, well, your security is pretty small. You may have great upside, but you have a lot of risk. So you just really have to understand. Next is what is projected return on your investment. And when I say return on the investment, you have to think about target return plus really risk adjusted.
Right.
So these are the key. Next one, fund income and taxation. So again, if you are participating in the notes, your income is in the form of interest income, maybe some fees, extensions, origination, and how is it taxed, right? It may be perfectly good for IRA money, but if you're investing in cash, you just have to be aware, interest income, you cannot deduct passive losses against interest income. So you have to be aware of all these things. Next, liquidity of the investment. So some funds are open-ended, some are closed-ended. Liquidity mechanism may exist or not. So you should have an idea. Fund fees, really important. How does the fund manager make money? How do you make money, etc. So understanding that. Obviously, frequency of payouts, management team, who they are. Probably they should be number one before you invest with anyone. Who are you investing with is probably one of the first questions, but who is the management team? It's on the list. It's just that I didn't put it in the first position, but it's probably one of the top questions.
Especially right now with the market being where they're at, and so many syndications taking place for the last 4 to 5 years, and a lot of them that are really struggling right now. Definitely.
Yeah, exactly. So now it's even more important to invest with the right people. Next, depending on what fund invests in, you need to understand the quality of the deal flow, how they source deals, and obviously the asset model, what they invest into. So understanding that is important. Question about, is it open-ended, close-ended? These are pretty basic questions, but understanding timeline of the fund, if it's closed-ended, how many years, when distributions start. Some funds don't start distributions from the get-go, although they have a pref, but you have to understand, pref doesn't mean cash flow. Pref just means seniority of distributions. And then if it's open-ended, subscription, redemption, what happens? Well, what you saw in the last couple of years is many open-ended funds got squeezed on liquidity. Like literally people ran to redeem, and if everybody redeems at the same time and you got a bunch of illiquid assets, like non-performing notes as an example, good luck.
Yeah.
Good luck redeeming. You're in the line. So next question, obviously fund investment strategies. So you have to really understand where they invest. It could be regional, could be income versus growth, could be asset class, multifamily, self-storage, industrial, open air shopping, etc., etc. And then this obviously a few other questions, but I just wanted to give you a top 10 questions off the top of my head.
Well, that's good. I mean, all those are very relevant. And I think so many people have gotten blinded by yield rates, promises on returns, and not doing as much homework as they need to in a lot of cases out there. That's one of the big things too. I'm always a big believer. Hey, if it sounds too good, you better double check on what's going on the paperwork and what they're investing in. Correct?
The words of the wise. Due diligence is difficult to do. A lot of people abdicate due diligence. They don't really do due diligence. They basically get to know somebody at best. They like the person. They don't even do background check. They don't even know who these people are. They don't connect. If they started to like them, is that enough to write a check? I've seen catastrophes doing that. It gets even worse when you have a friend and the friend didn't do diligence and they write a check and they say, yeah, I want to check into this thing, and you write blind that check because your friend did it. It's a significant process. Folks should take responsibility for their investment decisions. They should do at least three levels of due diligence. Who they're investing with, what they're investing into. They need to understand how it makes money. I've seen Ponzi schemes, bright and shiny objects.
Yep.
Ponzi schemes are the worst, of course. Then you got idiot management team who do stupid things, or you have incompetent people, right? So you absolutely have to understand who you're investing with, their team, their capability, their strategy. Obviously, understand asset model. And it sounds complicated, but it's not. You need to have an idea. One of the, by the way, advanced questions when you're thinking to write a check into a fund. This is one of the most advanced questions. What's in the fund? Show me the fund portfolio. And folks can say, well, what if they have 1,000 notes? Well, can you show me 1,000 notes list? Well, we don't want to show. Okay, can you show me how many of these notes performing, how many non-performing? What do you expect the unpaid principal balance? Look at the date. Like, I mean, basically, you don't always need every element of it. You just want to see how well they know their business, how well they're organized. And yes, if you have a performing debt fund, theoretically, and you have 20% non-performing notes, well, this is kind of a problem, right? You could look at the aggregate data and you could still draw a conclusion about the fund composition. So these are multiple elements, but at least you're doing the diligence on the team, folks. You're doing the diligence on the fund strategy, its assets, and then you could do also due diligence on a forward. No, what's the outlook? What do you think?
Right.
What are you doing next? So you showed me past history. Of course, you can look at the history of the returns. One of the most basic elements, historic returns since inception, last 12 months, last quarter. You look at a pattern. Hey, if it's a performing fund, is the performance getting better, worse? It doesn't mean, by the way, the change in performance is not necessarily bad news.
That's right.
Some of it could be market conditions. If the fund projected returns to be a certain level and they were outperforming and now they're in line, maybe that's not so bad. But if they were doing horribly, now they picked up momentum, maybe they fixed some problems, right? You just got to look at the data. So
yeah, exactly. A lot of those funds on the multifamily side, especially the last, have been hit with the interest rate, going up and affecting, their ability to repair the properties in a lot of cases, having to put that repair allotment instead of into updating the units to get increased rents. Now they're paying mortgage payments because they can't afford both in a lot of cases, or they overpaid for the asset in a lot of cases. That's what we've seen on quite a few of these apartment complexes, especially if you look at the Tides Group out of LA. They're losing, I don't know, 80% of their multifamily portfolio because of interest rate fluctuation.
Yeah, I'll just add this comment. This is a tsunami wave, a tidal wave that hit the entire industry all at the same time in broad scale. Certain regions worse than others. Sun Belt, I mean, Phoenix, parts of Texas, Florida. We're talking about 25, 30, in some cases higher percent corrections. When that happens is when the market shifts this much, your equity is wiped out. And on top of that, of course, liquidity squeeze. A lot of these value add deals borrowed on floating rate debt. And by the way, we see a ton of opportunities in this space, interestingly enough, today. But the source of the problem is value add deals that got bought with floating rate debt. And all things being equal, just the interest rate increase from wherever we were, you could have borrowed 4% rate, now it's 9.5%.
Right.
That alone is a massive liquidity squeeze. So some projects are still war for additional capital. They still were bought right. Some of them were renovated and leasing for significantly higher rents, but they still can service the debt because of the much higher rates. But there's light in the tunnel today. If you just hold out another year and a half, 2 years, the rate should come down substantially.
Right.
So just to tell you, it's a big problem, but problem creates opportunities. So opportunities exist in the form of, if you're a lender and if you're doing notes, some really interesting opportunities in mass financing, secondary debt, where you can come in and provide rescue and recovery capital and charge pretty high rates of return as long as you can feel there's enough equity safety behind you. Call it equity rich, but cash poor deal. Not every deal that was bought necessarily collapsed 25% in value. Some corrected maybe 5-10%, and they have enough room for additional capital, especially if they were bought right after COVID. Some really interesting. They were really discounted valuations for a short amount of time. If you pick something up right after that, you're still running out of liquidity. These deals do happen. So I'll kind of conclude on this point. It's exactly what you said. Tidal wave, and I'll add a couple of other factors. You're already aware, and other folks are aware. Let's call it the insurance hurricane that hit every insurance premiums are through the roof, especially in the hazard zones.
Florida, right? For sure, zones.
Yeah, and then you had cost inflation, of course, and then you had post-COVID collection challenges. A lot of them have cleared out. So if you add all those things, a perfect storm. But the assets could still be fundamentally solid if you bought it right. Now, if you overpaid and combined with all these performance problems, you got to turn the keys and give it to the bank. Maybe it becomes the non-performing loan, and maybe you could go trade it and buy it at a discount. I don't know.
Well, that was what we see on some of the stuff that's coming across our desk. We can buy that debt at a discount, But for it to make sense, we've still got to go ahead and finish the foreclosure in a lot of cases because of the underlying debt or the investors on the aspect of that the loans or the properties were initially overpaid for. We can buy it at a price that makes sense, but we've got to operate it without the encumbering debt and investors on the deal.
I was reading this article. I don't know how accurate it is because we playing now in mass space. We're not buying these distressed notes. Maybe you know more. I was reading an article. There was a big shop called Ready Capital, and they traded a lot of these loans, distressed loans, for about 70 cents on a dollar, whatever that means.
Mm-hmm.
So if you can buy 70 cents on a dollar, ultimately, some of these deals you might be able to get paid close to dollar on a dollar, either through some kind of a workout with the borrowers, especially if you can make a deal where they raise some capital, some mass financing or something. Because the problem is like this: a lot of current lenders, I'm observing it today, literally today. I've had yesterday conversations today. They're nervous. The existing lenders, they're nervous. They don't know whether they're going to get paid. So a bunch of them asking what? They're asking for insurance, tax, and interest reserves. They
Yep.
want to see more reserves set aside so they're paid, right? So if you can negotiate with the owners to set those things up, maybe you can give them extensions. If you own the note now, instead of the bank that's nervous and you bought at a discount, you have room to wiggle. But the banks are asking for two things: these reserves or pay down, right? So again, I don't know if you're trading, these are commercial notes, significant $40 million mortgages, $30 million mortgages, maybe even higher, maybe lower, right? If you're in a position to be able to trade that size and you're dealing with the nervous owner, you could pick it up and then make a deal with the owners if they can actually raise capital. And it's a function of who you're dealing with.
Yeah,
Or
I
finish
mean,
foreclosure, right?
yeah, exactly. Finish the foreclosure, especially depending on the liens out there. We were working with another group that was going to buy one, and there was $1.5 million mechanics lien applied to the property because they hadn't paid their contractors in over 24 months from when they started the rehab. So that was going to be a deal that yes, we could buy. It was originally financed at underlying loan was at 70% of LTV. Bank was willing to sell it at 70 cents on the dollar. That was it $30 million first lien they had. It was that, so it was basically picking up for 21 million.
Yeah.
And the current value is about 28. It's fallen down below a little bit. In the bank, that's what they want. They want the borrower, the owner of the property, to bring some cash reserves to the table. They didn't have it. Had to pay their mortgage. They can't, pay their mechanics liens.
Yep.
You can't bring in raise more capital because their investors are pissed off because the investors are going to lose their $10 million that they put into it to get the deal closed. So,
well, the owners are gone. I mean, the only way you could restructure, if you bought for 21 and it's worth 28, you have ability to restructure the loan.
Yep.
If you bought for 21. And this is the good old technique. You could tell them, listen, I'll restructure you down to 28. You bring in $1 million or somewhat too, or clear the mechanics lien or something along those lines. Maybe you could play this, but the bank will never do that. They'll just move the paper. But if you own the paper, then yes, you could even cut them down to 24, 25. They pay, right?
Yep.
So you have some of that restructuring contingent to their performance. So yeah, I mean, you can do that if you're in a position to be able to buy the paper and but the mechanics lien, depending where they're at, right? It can supersede primary debt. It becomes something you can't get rid of for foreclosure, right?
Mm-hmm. Yeah, it depends when we don't buy a lot up in your neck of the woods because it takes forever to foreclose up there in a lot of cases. But
I don't buy it here either.
Don't blame me.
This is a very slow foreclosure process here, very, very slow. But even in the faster foreclosure states, ultimately, you from the good old days that I learned, if you remember Eddie Speed, with his theories, you're really trying to restructure. You're trying to see if you can buy and get to know the owners and see if you can make a deal with them, either for deed in lieu or some kind of restructuring. You cut their principal as long as they start paying. So there's all kinds of creativity where you can get the non-performing paper to reperform way faster.
Yeah. And we've been doing it for a long time as well. Not as long as Eddie, but yeah, for about 20 years now too. So, and that's the interesting thing is we're seeing like I said, I've been talking about this for 2 years now, or actually closer to 3 years now. Like people were overpaying for assets back 3 years ago. It's like this is on floating rates. It's something we mentioned earlier. Like it's speculation that they're going to have this for a long period of time. If the wind changes, everybody's going to be in trouble. And we're starting to see the chickens come home to roost right now in a lot of the stuff here. Besides the multifamily class, what other classes are you seeing out there, or funds on specific asset classes that are also struggling? Self storage, industrial, anything else out of medical?
Yeah, so I through the podcast, through the Big Mike Fund podcast, I've had a number of people who are in other strategies. So storage is an interesting beast. I had some really sharp cats who are specialists of their own. And storage is all local, right? It's more local than multifamily. It's 1, 3, and 5 mile radius business. And in storage, if you overbuild, if the new supply comes in, it annihilates it becomes storage wars. Big REITs cutting prices like there is no tomorrow to drive occupancy. If you have an asset that you bought, you either built or somebody else built next to you and you oversupply, it's a significant long-term problem. So it's very regional, right? Some storage projects are doing totally fine, and some other ones you hear horror stories. The REITs are destroying them because they don't care. They will survive while they want to destroy competition, probably buy it out on the cheap. So you see a little bit of that. I can tell you what's doing really well. We've done quite a bit of that. It's throughout some of the funds. Open air shopping plazas. Interestingly enough, retail is doing very well. Very, very limited new supply. Rental rates have gone up over the years. Amazon effect has not destroyed them. In fact, we've seen number of pure e-tailers moving into the locations. Take Warby Parker, the eyeglasses store. It happened. And then you have even pure tailors who buy, supermarkets. They buy physical presence so that they actually enhances their strategy. So that continues to do really well. Industrial triple net, often single tenant, high quality, continues to do really well. They are very predictable. If you get into a project with the very high quality credit tenant, you're set. There's a lot of similarity between long-term industrial leases and open air shopping, right? Mm-hmm. We're looking at a mixed use deal right now. We're going to write a check from one of our funds. It's a super Walmart anchored, 90% of the retail, and 344 apartments above that from a distressed seller, right? So deals like this, sometimes mixed use can exist. Office is, I want to say this, it's a dog crap, excuse my language, right? A lot of office is fundamentally dislocated, and I don't see any recovery. There are exceptions, right? But in general, not an asset class that you want to do. Repositioning is ultra hard. Most people underestimate what it takes to reposition. So in this environment, honestly, if you're looking for deep buys, distressed debt like you're picking up, if you can get at the right price, or on the equity front, there are enough situations where owners are pressed to sell or becoming pressed to sell. So the deal I just mentioned, there's a distressed publicly traded REIT that's selling the asset because they have office property problems. They need to fix those problems with cash from selling high quality projects.
Right.
You could find what I call them not heavily distressed assets at a discounted price because of the market corrections. Mm-hmm. The crazy part, that deal is trading at 6.5% cap, while it was trading in the 4s before, right? So it's the damn interest rates, and if you can pick up quality assets when the interest rates are high, guess what happens when the interest rates fall? You get all kinds of tailwind. So on the equity front, as much as you can play equity today at a discount with the lower risk type of projects, it's pretty attractive. The other thing that we're really seeing is, I'm seeing two other types of opportunities. One, new deals struggle to raise capital. We did a second lien loan, mezz, sort of called mezz, a second lien loan, on a new ground up construction. It was an approved, fully entitled project to build to rent community, which is still in pretty good demand. The challenge is they couldn't raise all the equity on time. So providing a little bit of a bridge capital for 9 months seems to be covering the gap, at least let them close. And of course, existing deals, equity rich, cash poor, certain parts of the country, not South, but more kind of a Midwest. Mm-hmm. The interest rate problem is hitting everyone, Valuations corrected heavily in the South, but a lot less in the steady Eddie markets. So you could find opportunities for fresh capital investment without taking a lot of risk today. You can actually get equity-like returns without equity-like risk.
Yeah, there's definitely opportunities out there if you know where to look and understand it. I've got somebody that reached out to me and asked me this question I thought was perfect for you. If they're invested in a fund that is not doing well, what are some of the things that they could do to either get some of their investment back, all of it, or maybe none of it? What's the questions they should be asking if they see that their fund is struggling or they're in a deal that's going south pretty fast?
This is not going to be an easy answer, right?
Sure, right.
I mean, I'll give you a little bit of a framework, and it's really something that let me start with psychology. You have to go see a psychiatrist or psychologist first.
Yes.
You have to mentally prepare yourself that it's going to be a loss. And if you expect magic, you got to go to a magic show, right? The reality is, if you're in an equity of a fund that wrote a bunch of checks into equity deals, 21, 22, there are problems. How much? You have to talk to the manager. Step number one, really understand who you're dealing as a manager. Some managers are stressed, upset, some are not functioning well, et cetera, right? So if you're dealing with sane people, good folks, at least you go through legitimate conversations and you can go through portfolio analysis.
Right.
So the whole exercise becomes like this. And just so folks know, don't expect people to give you a very high confident answer because they don't know either.
Right.
You have to be very practical. And if you're dealing with a good manager who are handling things the right way, you'll get this type of conversation. Here's the portfolio, okay? We bought a list of 20 assets. I can show you all 20 assets. They can at least mark them yellow, green, red, right? Red, it's going under, and there's nothing we can do. It's already under, right?
Yep.
Now you got the yellows and the greens. Hopefully you got enough greens that these deals are doing fine. Then you start looking at the yellows. Can you help these projects? Is it additional money will help? Is it something else? Is it a change of management? Is it change of, right? So you basically focus on what you can impact. And then ultimately you can do some kind of projections, write all the zeros where you're going to lose all the money. Then you look at the greens and figure out conservatively what they're worth. Hopefully they're turning some profit. And then you look at the yellows and then you work out some kind of a good, bad, and ugly case scenario and see, maybe it's 20% haircut, maybe it's 30, maybe it's 50. In some cases, it may be 80% haircut. But at least if you get a sane kind of conversation, you can understand what's going on. And if it helps in your head, you wrote $100,000 check, now it's worth, 50. It might not even get 50 today. You would take 50 today. You might get 50 over the next 3 or 4 years. So structure of the fund, is it open and closed end? Also, please be very aware. If you own assets today, you're trying to sell, desperation. You don't want to sell right now. What you really want to hear is we stabilizing the assets. We are looking for a refi or maybe some additional mass financing that'll carry us for the next year and a half to 2 years. We'll sell it in a better market, right? If you hear that story, at least it's sane. Honestly, from monetary Fed funds rate theory, where the rates should be versus where they are now, rates are highly restrictive. Normalized rate should be 2.5. We had a 5.5 on the Fed funds rate. It means over the next couple of years, they're going to move it down. How much, we don't know. But if you do the basic math and you sell in 2 years from now, you're dealing with we're looking at a much better cap rates, right? Right. So you just got to survive. You really have to see if there's a path to survive. And of course, if you can pick up some occupancy on the way and a few other things, it might probably take cash. Most people say, well, why do they want to bring in additional liquidity in the deal? Well, because it can help. And there are multiple theories how to do it. Capital calls don't work. But if the deal is solid enough, maybe a member loan, maybe mass debt, maybe a mix of those. So the answer is you have to understand who you're dealing with, what kind of assets they have. it's not a fun game today for the fund manager. It's not a fun game for investor. But also keep in mind, do not despair and don't let recency bias hurt your future investment decisions. Why? Well, because people do absolutely the opposite. When the market is high, they wrote all these checks. They're gonna lose a bunch of money, and they're gonna shut off, go do something else, get very pissed, and then maybe go buy stocks. When the stock market is overvalued, overpriced, right? Who knows? I don't know. I have no comments on the stock market, but it feels fully valued. Who knows?
Yeah.
While some of the real estate is trading at a substantial discount. On a risk-adjusted basis, there are better opportunities to participate in both notes, debt, and some equity today. If you buy right, instead of shining away and look at the recency bias, well, I just lost on 8 out of 10 deals. Well, because the freaking tidal wave hit. I wish it was only one problem. It's interest rates is a tidal wave.
Yep.
Insurance premium is a tidal wave. All of it happened at the same time. So draw your own conclusions, get pissed off or get smart. Your choice.
Yeah. Try to keep the emotions out of it and have those real conversations.
Very hard to do, but
it's hard to do. I agree. But if you can have a conversation, and if the managers have a plan of some sort, it may not be plan A or plan B, but plan C to ride that tidal wave or get through that bad period. It's a much better aspect to hang around for a little while versus sell on a short basic basis or lose it altogether in a lot of cases.
Agreed. And patience is required. Patience is a virtue. It's difficult. And we've had conversations. We've done some deals that are struggling. And when folks want to know what's going to happen, and the answer is, here's what we're doing. This is how we're doing. And we're working very hard to maximize the value here. But you gotta be patient, because we can't even sell the deal. You put something on the market now, who are you gonna get to bid in the deal?
Vultures. Yeah, exactly. Yeah, exactly. Picking off the trash heap, you don't want that. When's the new book coming out, Mike? I know you mentioned that you were working on, and the book is How to Choose a Smart Real Estate Investment Fund. When is
that's the old book?
That's the old book.
The new book, I'm going to give a preview. I haven't finalized the title, but it's sort of along these lines. I'm trying to write a book a little more easier to read title, although it will have enough of the real estate. It's something along the lines of Journey of Becoming an Extraordinary Investor.
There you go.
Right?
Very good.
Something fun like that. So I don't know if I'm going to wind up on that title, but at least a little bit more of that, because people who read this, they don't want to, hey, top 10 questions to ask about it. It's too the previous was too formal. So this time it's a little bit more of a journey telling. Soon, I've had a draft for many months, and every time I come back and I read it again, I clean up a little more. I'm just gonna finish it by a given date, perfect or imperfect. It comes out, then there can be second edition or third edition.
There you go.
Not looking for perfection, looking for progress.
There you go. Exactly. Well, when you do have it out, we got to have it back on, or let me know. We'll be glad to help promote it and blast out to everybody as well for you. What's the best way for our listeners and our audience to, connect with you or follow what you're doing or check out more of the things that you're offering up? What's the best way, Mike?
Sure. It's going to get really cheesy. So I come up with a podcast named Big Mike Fund Podcast. People have called me Big Mike. Back to the CG Mastermind. I think Goldright actually ultimately said, yeah, you got to call your podcast Big Mike Fund Podcast. Why? Because you're a Big Mike, right? And you're a fund manager. So it's stuck, right? So bigmikefund.com. It's that easy. Don't have to remember Temple Funding, Temple Family, bigmikefund.com. And if you misspell it, you forget D at the end, bigmikefund.com. I promise it's not a kinky site.
Exactly. Make sure that D on the end of fund.
Well, I actually was doing a podcast recording with somebody just like you, and I told them bigmikefund.com, and they didn't hear the D at the end. They said, did I hear it correctly? Within 30 seconds after the end of the call, I go to GoDaddy, I grab bigmikefund.com, I do URL forward to bigmikefund.com to make sure I don't wind up in the wrong place.
Well, that's one way to find a performing asset.
Yes.
Oh, this has been a blast, Mike.
Wise, yes.
Exactly. Well, this has been a blast. Thank you so much for coming on, sharing your insight. Make sure you go check out the book, ladies and gentlemen. Grab you a copy of that. Get a copy when he comes out with a new one, but listen into the podcast. It's a great podcast, great questions, great operators, just an absolutely joy to listen to. That's the Big Mike Fun podcast. Check it out there. Mike, thanks so much for joining us on here. Everybody go out.